I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer. And I'm telling you, I have been groomed for this moment in time. I'm getting chills. I'm really happy to be here today. So we're going to be looking at the potential death of the metals market, because you have to understand that implementing Basel III has been postponed and postponed and postponed. Now, part of it is possibly going to be implemented the end of this month. And it asks the question, will that implementation of this part of Basel III boost gold and silver prices? The current schedule for full implementation, well, right now it's the banks in continental Europe that this part, and we're just going to focus on the gold and silver part for today, but that would be implemented in continental Europe. Lest you not think that that would impact us here, you know that the entire global banking system is incestuously interconnected. So it does not really matter where it happens, it's coming home. British banks are supposed to begin the implementation in January 22, and all changes are supposed to become effective in, what year is that? Oh yeah, 2023. Now, what else is happening in 2023? Well, we've talked about the LIBOR and the need to restructure all of the contracts that mature after that certain date. Well, that's been postponed until 2023. Anything else? Oh yeah, the Fed anticipates having the digital dollar ready by 2023. So that seems like that's going to be a pretty big year. But will they start to bring in the implementation now? We'll find out. What you need to know is the LBMA is the largest gold and silver trading platform in the world, trading, roughly 5 trillion annually, not in physical because there's not that much physical out there, but in contracts, derivatives, which are just a bet. You cannot convert a derivative contract into the underlying asset. The COMEX here in the US is the second largest gold and silver trading platform. Virtually all of this trading is in the form of unallocated precious metals, which means you might own them and they might be holding them, but they're not held specifically in your name. That means that they're really using the fractional reserve system. Oh, I have this 1 ounce of gold. I think I will trade, 100, 1,000, 62,000 gold contracts against this 1 ounce of physical. I'm going to read this whole piece, and I'm going to also encourage you to go in and follow all of the links in the blog. But how huge is this paper market, where banks may hold paper contracts to cover their liabilities to deliver physical precious metals? In a Commodity Futures Trading Commission hearing in March 2010, precious metals consultant blah, 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 that these institutions may have sold their physical metals as much as 100 times the quantity of metal that they actually owned. Obviously, if all these owners contacted their bank to take delivery, the paper market would crash. Okay, now he's saying 100 times. I personally saw with my own eyes, unfortunately before I knew about print screen, that according to the Bank for International Settlements, for every 1 physical ounce of gold that exists, there were 62,000 derivative contracts. That's why you kind of see me hesitating. Look, the bottom line in this, and I'll go through everything, do I think that it's actually going to be implemented on June 28th of this year? I don't really think so, but I got to tell you, I could certainly be wrong. This is not something, look, if it was in my control, it would have been gone a long time ago. But I was surprised when they allowed Lehman to go out too. So I can't say for sure, but we're going to know in a few weeks whether or not this is actually going to be implemented. Even if it was only 100 times, yeah, it could certainly crash the metals market. Now, these are the monthly ounces in gold derivative trading just since December 2019 through May of 2020. So in terms of ounces, you know, it's a substantial amount, obviously, and it doesn't exist, just paper gold. It's easy to create as much gold. That's a push of a button. And it's cheap. It's very cheap. It'll cost you, what, $150 to control 500 ounces of physical gold? That's dirt cheap. This, you've seen this before. These are in the FDIC insured banks, the precious metals notional derivative trading, and how much that's grown. And this is through the first quarter of 2021. So does it make it easy to suppress the price? Plus, how many of you have asked yourself, if there's such a shortage, especially in silver, but in physical gold and silver, how come the prices remain this low? This is why. It's easy to do if you get to be close to those that write the rules, and we'll see if they're actually going to change them. Because this is from the Bank of England, the SACCR framework, so this is central counterparty risk, all of that, applies to over-the-counter, so OTC derivatives, exchange-traded derivatives like GLD, SLV, and long settlement transactions. Long settlement means that the settlement goes out years, okay? And it scared the LBMA, the LPMCL, which I'll explain in a minute, and the World Gold Council so much that they wrote a letter to the financial authority in England, but I want you to know who these guys are. They represent the global OTC market, which is going to be impacted by this. Participants in these markets include central banks, mining companies, precious metals producers, bullion banks, refiners, and fabricators. And then the London Precious Metals Clearing Limited, so this is the central clearinghouse, was created by the LBMA members. And who would be that's 4 of the bullion banks: HSBC, ICBC Standard Bank, JP Morgan, and UBS. So these are the guys that work in this area. We know this. And the default settlement location for most global OTC spot gold and silver transactions is London. Okay, so it matters a lot. They use the unallocated account. In other words, you buy some gold, you're having them store it for you, but it's in a general account, which is a lot cheaper, right? A lot cheaper. And so that gives them the right to actually use it for their benefit. Now, the World Gold Council is the market development organization for the gold industry, and they help create lots of gold products. So this is really going to matter to them because these are the guys that create, trade, and control the precious metals market. And why all of us have been I personally haven't really been frustrated because it just I look at it like this gives me the opportunity to continue to accumulate at bargain basement prices. But a lot of people have been very disappointed. And this, they work with the central banks because a rising gold price is an indication of a failing currency. So these are the tools that they've used to suppress the price of gold and silver, even when it makes no sense at all. Personally, I think we should all be taking advantage of that. So I wanted to just specifically look at gold's role in Basel III because it moved up to a tier 1 or virtually risk-free asset. Well, this is risk-free, and it holds no counterparty risk. I hold it, I own it outright, and it's invisible. And I came across, I wish I'd come across it a little bit sooner, but that's okay, a great piece, again, from the biz on gold's role in the central bank's reserves, and we're going to come to that later. But it has physical gold has been given a 0 risk weight because gold bullion held at the bank or held in another bank on an allocated basis. In other words, if another bank is holding this, my name is on that coin, so they cannot trade that coin.